Ladies and gentlemen, good day and welcome to Sansera Engineering Limited Q4 and FY22 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. B.R. Preetham, Group CEO, Sansera Engineering Limited. Thank you and over to you, sir.
Thank you. Good afternoon, everyone. Am I audible? Shika?
Yes, sir, you are audible.
Okay,
you can proceed.
Thank you. So, welcome and thanks for joining this call. On this call, I'm joined by our CFO, Mr. Vikas Goel, and Praveen, who's head of our operations. And also we have SGA team who are our investment relation advisors. The results and the presentation are uploaded on the stock exchange and the company website. I hope all of you have had a chance to look at it. I am delighted to be here today to talk about our FY22 and Q4 results and the progress that we have made since our last earnings call. This has been a milestone year in the history of Sansera, which started with our IPO, and we are grateful and thankful to you and your tremendous support. With our perseverance, we navigated through one of the most challenging years that the industry has ever faced. I am very, very happy to say that we crossed 20 billion rupees in revenues and also registered our highest ever quarterly sale of 5808 million in the Q4 of this year. We are also delighted to share with you that board has approved a dividend of 100%, that is on the face value of rupees 2 per equity share for FY22. In line with our strategic priorities, we have built a very healthy order pipeline with a 20% increase in our annual peak revenue as of April 22. It is close to about 15 billion rupees. This 20% increase of our order pipeline of 12.5 billion as of September 21 is after considering almost 5 billion of orders moving to the mass production, which we have reset, which means that the order book which was present as of September 21st, so we have moved the components or the orders which have started mass production. So this is a very broad-based growth across 99 auto and non-auto customers from India and international. 9 of these auto customers have placed orders for XEVs. Another aspect is our high focus on diversification. That is, two-wheelers, which constitute 47% of our current top line, only represents 15% of the total future pipeline. Also, global orders constitute 61% of the pipeline. See, both these are in line with our strategic priorities. With respect to some of our recent order wins, there have been several of them, but as we feel that these are some of the very milestone orders, so we have recently won a very big order of 30 billion rupees from a leading North American OEM for connecting rods for their upcoming project. We have already been supplying components to multiple locations of this customer for several years. This order further strengthens our relationship with them. We have also bagged orders for 2 packages consisting of 26 aluminium forged and machined parts from BMW Motorrad, amounting to approximately about 3 billion Indian rupees over the next 10 years. Now, I would like to mention here that, on this aluminum forged and machined parts, we have been getting several of interest and orders from several international and domestic customers. But what we have mentioned here is a very strategic order, which is kind of breakthrough for us in the aluminum forged and machined components. We have also been lauded for our creative technology and environmental initiatives from our customers. So, as we had announced it in the April this year during the 30th GM Annual Supplier of the Year Award held at Phoenix, Arizona, USA, General Motors awarded Sansera an Overdrive Award, which recognizes our outstanding achievement in one of the 6 global purchasing and supply chain priorities that enable to navigate their business results with focused initiative and cutting-edge culture. Sansera has been awarded by HMSI, Honda Motorcycles and Scooters India, for environmental initiatives. Norbremse, which is one of the world's leading manufacturers of braking systems and a leading supplier of the other safety critical rail and commercial systems, presented Technology Support Award to us last month. We supply critical components for the braking system for Norbremse for their export requirements. I would like to mention here that we have set up a fully automated line for this very critical braking system component, which goes into the commercial vehicle for their export requirement. The production is just about to begin, and there was a team from Norbremse who were extremely happy with the setup that they saw in our Pune facility. Coming to some recent developments in the industry, as per the data published by SIAM, overall industry witnessed a degrowth of about 6% in FY22. Sales of all 4 segments of the auto industry are below even 1890 level, despite some recovery from a low base. Passenger vehicles, commercial vehicles, and three-wheelers grew on a low base of the industry in 2021. However, two-wheeler segment saw 11% decline from the previous year, largely due to weak rural demand. The semiconductor shortage seems to be easing to some extent. However, the input costs will continue to be a challenge in this year. Having said that, cut in the import duties on the ferronickel, coking coal, PCI coal, coke and semi-coke, coupled with a hike on the duties on iron ore and steel exports, which was announced over the weekend, could result in some respite. Otherwise, at least will stabilize the prices. Additionally, we are also having ongoing discussion with our OEM customers and offsetting this this inflation as well. Coming to our performance, Sansera continued to deliver a better than industry performance with a total revenue of 5808 million and an Ebitda margin of 7.2%. Our CFO Vikas will talk about this in detail a bit later. Our auto segment, which caters to global and domestic OEMs across two-wheelers, passenger vehicles and commercial vehicle space, contributed around 90% of our sales in Q4FY22. Overall auto segment grew by 18% in Q4FY22 on a year-on-year basis. This was an all-round growth across the categories, led by significant surge in PV sales. So, in scooter PV sales. In terms of current sales mix, motorcycle contributed about 36% of our top line. Passenger vehicle accounted for about 29% of our top line. Commercial vehicle accounted for 13% of the top line. We expect PV segment to benefit from commercial vehicle upcycle as well. Within our auto segment, auto tech agnostic and XEV products across all categories contributed 7% of the total sales. Within the non-automotive segment, we manufacture a range of precision components for the aerospace, off-road, agriculture, and other segments, including engineering and capital goods. This segment contributed about 10% of the sales in the quarter. In our current mix, aerospace, off-road, agriculture each accounted for a tune of 3% of the top line, and the remaining 1% of the top line came from few other segments. On the capex front, as we had announced, we completed a capex of around 2,550 million in FY22, which was also in line with our projected capex plan. Out of this, we have recently finished the setting up of phase 1 of our dedicated facility for hybrid and electric components within our existing plant in Bangalore. We are optimistic, and with the response that we have received from the EV space, this facility would be fully used in a couple of years. We have already started the secured business from both traditional OEMs and new age startups in the EV space. The production of both hybrid and EV components has commenced in this facility. Further, we are constructing a greenfield manufacturing facility in Bangalore dedicated to aerospace and defense, which is expected to come on stream by the end of Q4 FY23. With this new plant and a ramp-up of production schedules by aerospace OEMs and the defense OEMs, we expect a considerable uptick in this segment FY24 onwards. Going forward, we remain focused on the qualities that differentiate Sansera, which are operating excellence, product quality, ensuring the continuity of supply to our customers, and generating profits. We have witnessed a strong momentum in demand for new components and business, and currently we have about 255 components under various stages of development, including auto and non-auto, excluding aerospace. We are also working on another 300 components on various stages of RFQ. The aerospace pipeline, which is typically works on a large packages, is also pretty good. I would like to reiterate that we are committed to consolidate and strengthen global share in the existing portfolio, as well as diversify into non-auto technology agnostic components. So typically our order wins in the global auto segment, which is primarily connecting rod, is very much in line with our plan of achieving 10% share of business globally. I now hand it over to our CFO, Vikas Goel, who will take the presentation forward with the consolidated financial highlights. Vikas.
Thank you, Preetham. Good afternoon, everyone. I will first start with the performance during Q4 of FY22. So our revenue stood at 5,788 million against 4,960 million in the previous year, which is a 17% growth year on year. We saw an increase in the raw materials cost in the past few quarters. However, we were able to pass on these increases to the domestic customers quickly, and in some cases with a slight lag of up to 3 months. The Q4 gross margin had a decline of approximately 4%, primarily due to lag in the price increases as a domestic sales. The optical effect of numerator and denominator cost being added in the sales as well as in the cost, and also slight squeeze in the margins on the international revenue due to the material price increases. I will cover a little bit more about this in the annual performance section. The Ebitda stood at 1,000 million as against 1,044, a slight decline. The Ebitda margin for the quarter stood at 17.2%. This small degrowth in Q4 22 was driven by fall in the gross profit, higher employee costs, primarily due to the salary increments and the ESOP costs that we provided for during the quarter as against last year. Some of the other expenses which increased were largely in line with the volume growth that we had during the quarter. The quarter also registered higher finance costs due to an increase in the borrowing cost, primarily volume expansion and some capex investments. The profit after tax stood at 374 million for the Q4 against 472 in the Q4 of last year. This was a degrowth of 21% year-on-year basis. The geographical sales mix for Q4 stood at as follows. India revenue was 63%. The revenue from Europe was 24%, USA 8%, and other foreign countries about 5% of the total revenues. Now we move to the full year performance. Our revenue stood at 20.05 billion as against 15.7 billion for the last year, which is a 27% year-on-year growth, and it's a record revenue that we achieved. We crossed the threshold of 20 billion rupees in our revenue for the first time. Notably, within the overall revenue, our domestic revenues in India registered a 24% growth. The exports from India registered a 40% growth year-on-year, and our business in Sweden grew about 20% over a year. So all elements of the business had registered a growth despite difficult market conditions during this period. Our Ebitda stood at 3,491 million as against 2,952 million for FY21, a growth of 18% on a year-on-year basis. The Dividend Margin for FY22 stood at 17.4% versus 18.8%. And now I'd like to explain a little bit about this. I spoke about gross margin. So optically, our gross margin shrunk by about 1.5% due to the material cost inflation, and some of that got recovered due to higher export mix and other efficiencies that we could generate. So net impact that you would see on the gross margin is about 0.9% on a year-on-year basis. The net profit for FY22 stood at 1,319 million. I'm happy to share with you that the board of directors has recommended a dividend of 100% of the face value of rupees 2 per share for FY22. We incurred a capex of about 2,550 million during the financial year with an ongoing programs for our capacity expansion, capability enhancement for new product lines that we have got orders for. The geographical sales mix for 22 stood as follows: India 63%, Europe 24%, USA 9%, and other foreign countries. On the net debt front, our net debt stood at 5,948, which is about 1,100 million increase from the last year. With this, we conclude our presentation and open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Participants present on the audio bridge who wish to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Basudev Banerjee with ICICI Securities. Please go ahead.
Yeah, congrats sir for the good set of numbers. Just a couple of things. One, if you can give us the growth breakup for this quarter, as QOQ revenue is up almost 18%, where domestic two-wheeler industry is down some 8% sequentially. So such a beat in terms of revenue, how much is commodity inflation and which segment did best to drive such a growth on a sequential basis, if you can explain?
Yeah, good afternoon, Basu. You were referring to our Q4 numbers, right?
Yes, sir. Q4 over Q3 growth is far higher than domestic two-wheeler industry growth. So which areas resulted in this huge sequential revenue jump? How much is commodity inflation and which specific areas resulted in that jump? And how much do you see those specific, any specific one-off execution, or how to look at that improvement? Broadly, that's what I was trying to do.
Yeah, basically, generally, if you look at Q3 will be always a subdued quarter because the change of financial year, the quarters. So if you look at all the 3 quarters, the Q3 will always be a subdued quarter. So generally Q4 will be our always Q4 will be our best quarter if you look at that way. So we have had growth in all sectors. We have had growth on two-wheelers, passenger vehicles, and also if you look at our exports also. All the fronts we have grown compared to Q3 to Q4. So it's not any particular one sector that we have grown. I would like to say that we have grown in all the sectors, including non-auto, aerospace, which includes aerospace, passenger vehicle, off-road vehicle, and agriculture. So there has been an overall growth compared to Q3. If you are referring to Q3 and Q4.
And so you were mentioning last time that some lag effect of price hike for Q3 will come in Q4. And overall, how much was price pass on to customers in Q4?
No, see, overall, in the whole of the year, approximately about, we had to, the overall effect of the steel price increase is around 55 crores. So we have been able to, get most of it into the system by the end of the quarter. There is a very little, increase that has to come from one of the customer who would have a delay of 1 quarter. Basically, that would come into the Q1 of this year. Otherwise, most of the price increase has been passed on to the supplier, and also we have received it from the customer side.
Sure. Second question, sir, I missed out initially. You said the ESOP cost accounting was part of employee cost or other expense?
It is part of employee cost, yes.
Yeah. So if I see your revenue growth being 18% sequentially, where other expenses were almost up 30%. So either other expenses were deflated last quarter or some one-off this quarter. How to look at it, sir?
So some of these costs are variable with the revenue, and if you look at quarter-on-quarter increase, it will not be giving a right picture. So like the freight cost, and there are certain other execution-related costs which are variable in nature.
Sure, understood. So those freight, etc., so those pushed up other expenses. And last question, sir, any outlook? So if I look at two-wheeler retail numbers, they have been improving since March. May numbers were better than March, and April numbers were better than March. May first half is better than April. So how are you looking at the two-wheeler demand progressing from your key customers, and any overall revenue guidance for FY23 if you are giving?
Basu, yes, we are also hearing that there is an improvement, especially after the sentiments could get better after the government's initiative on reduction of taxes on fuel. And our key customers, some of our big customers, have indicated a positive growth for this year. It varies from 5 to 10%. Some of the customers have indicated 5%. Some of them have indicated up to 10%. So we are, please understand that there have been continuously degrowth for the two-wheelers. So we expect that this year there would be a positive growth between 5 and 10% from the OEMs. But as far as our revenue growth guidance is concerned, we have always maintained that we will grow much better than the industry. But to be very frank, that things are quite fluid at this point of time. There are several uncertainties for which we still do not have a clear-cut or time-framed answers, which does not get limited to the Ukraine war or the commodity price increases that are being spoken about, or even the power shortage that is happening in some of the countries in Europe, which could affect some customers as well as some imported steel or child parts. But looking at all these uncertainties, we still feel that we would do much better than the industry. We have a very positive, order book, but I would not like to give any guidance at this point of time. Probably I'll wait till the end of the first quarter and we meet for the quarterly results. Probably things could be more clearer where we could discuss it.
Sure. And last, if I can squeeze in, you mentioned aerospace was roughly 3% of revenue. Am I right, sir?
That's right.
So which means roughly 18 odd crores. So as far as I remember, your existing aerospace capability peak revenue potential you mentioned was roughly 120 odd crores. So which means annualized revenue still is roughly around 80 odd crores. So when is that new facility getting on stream? And as per your firm orders in aerospace, by when you see your existing capacity operating fully?
This year was better than the last year in aerospace compared to the revenue. Last year we have grown this year 7%, but things have started becoming much better and clearer in aerospace. So we expect very positive growth this year. We expect close to about 35 to 40% growth in revenue in aerospace sector this year. But having said that, the new facility would only get ready by the end of second quarter, and then post that we would have some first article production and then approvals by the customer, then recertification of the plant, new facility. All this will take another 2 quarters, I guess. So we would look at the mass production from the new plant to start from the new financial year. So in our estimates, we expect at least a CAGR growth of about 25 to 30% in aerospace for the next 3 years.
That's great, sir. Okay, thanks.
Thank you.
Thank you very much. Ladies and gentlemen, in the interest of time and fairness to all participants, please restrict questions to 2 per participant. Next question is from the line of Vaibhav Shah with ICICI Prudential Life Insurance. Please go ahead.
Yes, thank you. Thank you for the opportunity. Good afternoon to the team and congratulations on good set of operational numbers. My first question is regarding the order wins which you have stated. So this rupees 30 billion order from a leading North American OEM. So I just want to understand that is this a part of what we were already supplying to them, or is this for a new platform? And a question connecting to that would be that would we be required to do any specific capex to meet this order requirement, or will it be supplied out of our existing facilities?
Good afternoon, Vaibhav. This order is for very new technology engine. This is not in mass production currently, so it's a totally new technology which would be much more greener than the existing technologies that we are talking about. So there is going to be an investment that is going to be made this, because this involves a very big production volume, close to about in excess of 5 million components every year. So we are, as we had indicated last time also, we are looking at setting up a facility in North America, most probably in somewhere in US. So this facility would be prepared to cater to this requirement, because at these volumes, customers have actually indicated that this should be done. Most of the operations have to be done at the plant which we will set up in US, and this goes in line with our strategy, because we were looking at setting up a plant in US to attract higher share of business and also more content per vehicle from the North American customers. So this is in very clearly in line with what strategies we have laid out for Sansera for the future growth.
Sure, sir. So,
this would not be replacing any of our current orders. because currently we are supplying to this customer, though from last several years, but our share of business currently with this customer is far smaller because we are supplying out of India. For this program, we have been nominated as a single source.
Sure, sir. So, just a follow-up on that. What kind of investment are we looking for to set up this to meet this order requirement? And do we have sufficient orders to kind of generate a decent ROI out of this investment? Probably are we looking at some other customers as well, right? North America has a presence of large customers in form of both EV, four-wheeler OEM as well as traditional OEMs, CVs also. So if you can highlight probably what kind of investments are we looking for, a broad range, and what kind of revenue and net could we expect out of this investment?
Yeah. Yes, this facility will have to be set up by 2025. So we would not, we are not looking at any immediate, investment. The investment should happen in 24 because the production would start. Of course, the land and building will have to be made ready. If we are going to lease a building, it would be much lesser upfront investment on the building. But if we are going to do a greenfields, that decision is not yet taken. As I speak, our senior management, including our chairman and managing director, are visiting several of these shortlisted sites along with our team. So, depending on the location availability and then the benefits that we get out of different locations, we would take a decision. And then later on present a comprehensive plan to the board, and after the approval I would be able to share this. But if you look at the revenue that we are looking at, it could be very close to about 75 million at its peak per year. So we would be looking at a peak investment of close to about around 30 to 35 million. So it's a very rough initial estimate that we have, but this could change depending upon several other projects that we are working on. I'm sure that you would appreciate the fact that we will not be looking at a plant for only one customer and one product. We have already we already have an order book which actually was there for us to execute it from partial execution from US. So this would be, in addition to that, this is a big order that we have received. So we have also in discussion with several of our existing as well as new customers for a business that has to be done out of this place as well. So everything is still very, very in the initial stages. I will be able to give you more information on this in the coming quarters when things become much more clear.
Sure. That's very helpful. One last quick question. If you can just explain the export mix out of the total exports that we do, and if you can probably also explain that do we have a commodity pass-through clause for each of the segments within the exports, or are there any specific clauses which are built in?
Yeah, the exports actually contributed to, the exports from India was about 28% of our total revenue. Then overall, the exports grew by 40% last year. So our exports from India grew by almost 40% year on year. And we generally categorize this exports, two-wheeler, mainly our exports are into passenger vehicle, two-wheeler, commercial vehicle, and off-road. Apart from aerospace. And off-road customer, one of these customers to whom we are doing, there is a pass-on of the raw material. Then, in the aerospace also, you understand that above 5% of variation of the thing would be a pass-on, but with a lag. And this off-road was also with a lag because we have an agreement of 1 month raw material will be reset. But on the passenger vehicle and commercial vehicle front, as I had explained it during the last calls also, these were all fixed orders, fixed price steel orders which we had signed. But due to an extraordinary situation, customers were willing to look at it, and some of the customers have already agreed for compensating the price effective from 1st January, and some of them have in the consideration. So we are very, very hopeful that most of this price increases that have taken place will be passed on in the exports also. May not be from the retrospective, but it will be mostly from the prospective.
Okay. Thank you. That's it from my side. Thank you.
Thank you very much.
Thank you. Our next question is from the line of Ankit Kanodia with Smart Sync Services. Please go ahead.
Thanks for taking my question. So we just wanted to understand as to when the auto OEMs in general are having a very tough time, at least in the domestic market, as we see, and we see consistently good results and good order booking from your side and also some of your competitors. So can you just give us some broad outlook as to how is the auto cycle in general, and taking cues from the past, how do you make sure that we are nearing the end of the down cycle and probably the up cycle is going up? Any sense you can share with us which can help us in understanding the industry better?
Very good question. I'm sure everybody is looking forward to finding an answer for that. At least I don't have an answer that how do we have to predict the cycle, though this is a very cyclical business, but we are actually caught in last 3 years have been, or 3 to 4 years have been a continuous degrowth due to one or the other factors. Started with, at least in India, changing over to BS6. Prior to that, the increase in insurance costs, then GST, and then technology changes, and everything has been contributing to the degrowth of the industry. But at least some of us, or most of the auto component manufacturers, we are also participating in the global program, and as India is also quite well positioned to quite well positioned and appreciated for our work in the area of component development, consistent quality, and also clear cut price advantage that we have. And the China Plus policy has really helped to acquire more and more businesses. Now, as the vehicle cycle is now getting into a newer set of engines, newer platforms that are going to come up in the next couple of years across as the technology is also changing, a lot of outsourcing is also being done from the OEMs, which were traditionally otherwise being done now. So all this that is one of the key reasons why we have also always said that our global share of business, which was around 3 to 3.5% a year back on the connecting rods, which we supply to several segments, is poised to go up, and we have targeted at least that we should reach about 10% of this. And these are quite big numbers, and it is this kind of order wins from all across sectors is keeping our growth above the industry average, and we expect that this would continue, because just to give you some split, in the last year revenue, almost about 25% of our revenue came from the new products. So though we had a 5% growth on our legacy business, almost 25% of our revenue has come from the new businesses that were either started previous year or from FY19. So this is the kind of order book that we have, and it continues to grow. So we are very positive that we will be able to outperform the industry in the future as well.
Thank you so much, sir. That really helped. And my second question would be related to our big order win of 30 billion INR. So just wanted your understanding on this. As in, so when we take a 10-year contract, it's very difficult to understand how the inflation will play out and how the currency will behave, since it's a export contract. So how does our contracts work? As in, every year we have mentioned that we'll be supplying them 35 million connecting rods. So do we is the rate decided every year, or how does the contract work over here? If you can give more color on that.
Yeah, generally these kind of contracts, when we sign, we are very clear about the place of manufacturing. In this case, we were very clear that this execution will not be from India, it would be from US. So there will be no currency effect on this order, because our place of manufacturing and place of sale will be the same. So we have costed this component as per the cost that would be prevailing in that country, and we have also taken the inflation into consideration while doing so. But having said that, most of our export orders, we have there are several ways of signing a contract. Two of the most popular ways are that you, with a clear understanding with the customer, you actually upfront load the inflation, as well as take a calculated cost onto the raw material inflation as well, and put it upfront, load it into the contract, which would be generally 5 to 6 years. Now, there is always a scope for speaking with the customer if there is a substantial increase or decrease in this cost. Generally, this is agreed that plus minus 10% on whatever we have assumed will not really change the working. So this is one way of contracting. The second way would be always look at either a 3 year or a 3 months or a 6 months or a yearly reset of the raw material cost, which would go on an index based. So we have, it depends on customer to customer what they would like to have. So it would be discussed and agreed upon. So we would have taken in our calculation, as we have data for several last years. So we would have taken an inflation both on commodity as well as on human resource as well as on the raw material while the raw material is bought out. So in this contract specifically, the raw part is a bought out for us, which is contracted separately by the customers. So we would not come into any kind of inflation on the raw material on this specific contract.
Thank you, sir. And since we mentioned that this would be done in US, so how do we see our costing or cost of manufacturing in US compared to India? And in your previous calls and also interviews, I've heard about your aspirations of growing the US production much higher than what it is right now. So what are your thoughts on the different cost of production when you are doing it in India, and what are the advantages we see when we have our production house in US compared to India?
So we would have a mix of our machines as well as bought out machines. We would have a significantly higher level of automation which would be done from our machine building and automation cell. So the cost of capital per se in US itself is going to be cheaper compared to in India, at least by 3.5% the cost of capital. So with all these things, we do not expect that there would be any compromise on the margins. In fact, with the level of automation that we are looking at, we would expect that there would be a slight uptick on the margin on these products. And these products are, when we say that we are going to do it out of other country, we would have costed on that basis. We would not have taken the Indian cost and later on try to decide. So upfront we would have taken those costs and done it. So because we have this advantage of using Sansera machines and automating them, so we are quite confident that we will be able to, if not better, maintain the margins that we now have on these products.
Thank you so much, sir. That really helps. Thank you. That's all from me.
Thank you, Ankit.
Thank you. Our next question is from the line of Siddhartha Bera with Nomura. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, for just finishing off on this North American order, so last time you had indicated a capex plan of about 750 crores over the next 3 years. Now with this order, how does this change? How should we think about it over the next 3 years?
Because
So our 3-year plan, which we indicated during last year, remains intact. This new order, as Preetham just explained, this deliveries have to start in 2025, and the investment will happen over 2024. So there will be some interchange.
Ladies and
Hello?
gentlemen, we have lost the line for the management. Please stay connected while we get them back on the call.
Because
Disconnect now.
hello.
So you've been connected? Yes, you can proceed with your question.
Sorry, we got disconnected. The idea is that this 50 crores what we had indicated would not have a significant portion of this investment, because this would be beyond, most of the investment would be made in F24. So this was not considered. And there would be some, we had considered a small amount for the US facility, which would continue to be there within 750 crores.
Oh, so fair to say that nearly it can go up by somewhere about 200 to 300 crores over this period if we...
No, I don't expect that to happen in this period. I expect that it would go, close to about 100 crores could increase, but that again depends on the other contingency, the thing also we have had. So I don't expect too much of a change. So it could be probably in the range of between 750 to 800 crores. We still, working out the final details. I'll probably be able to answer to this slightly during the first quarter call.
Understood. So second question is on the orders. So we indicated that we have started production of the 5.1 billion orders from this year. So a large part of it will come in this year. Will it be a fair assumption, or it will be spread over the next 2 years?
No, I think it will be spread over the next 2 years, but we expect that this would contribute also, substantially this year as well.
Okay.
Yes, most of this 5 billion would be coming. I mean, maturity would happen most of the components in this financial year, which is FY23, and some portion might go to FY24. But this 5 billion is actually overall order book that we are eliminating this year, setting it right, and beyond that we still have another 1,500 crores. Order book.
Correct. Yeah. Understood. In case of XEV customers, I think last time we highlighted that we were in discussion with 3 more of them. Would it be possible to share any more updates? You have any more discussions? Where are they right now, and by when do you expect some of these order wins also to come through?
Yeah, as far as the two-wheelers are concerned, we have already on board 5 of the EV manufacturers. We are in finalization with a couple more. So we expect that we would be working with at least 7 to 8 on a long term, if not more. But on the passenger vehicle, it is still a lot of discussion is taking place with few of the customers. I probably would not like to indicate both domestically as well as globally. These are both in terms of steel and aluminum forged components. So as of now, we have confirmation that we are working with two of the PV manufacturers, one global and one MNC out of India. But then on commercial vehicle also, both these are export orders. So there are several of inquiries that we have. We've been working, going and presenting a lot of our capabilities as well as the products that we have developed and we are working on. So we're quite hopeful that every quarter you will see an improvement on this front from our side.
Okay, understood. Sir, last question is on the Sweden. So how much will be the EBITDA for FY22 for that entity? And going ahead, how do you think there will be more margin pressures coming up because of the energy costs in Europe going ahead?
Yeah, I'll give it to my colleague Praveen, who actually involved fully in Sweden on the operations front. As far as the EBITDA was concerned, this year, we ended up with a 7% EBITDA on Sweden. But this year there will be a change because we have some product mix change. Praveen, you could explain.
Yes, Siddharth, this last year, that is FY22, the EBITDA was 7%. And going forward, this is FY23, there is a slight change because they wanted to, they have actually developed another source because they wanted to not rely on us on 100% of a particular product which we have been supplying. And in place, they have given us 11-liter and 16-liter engine connecting rods. So these are under development as of now, but the real growth out of these will come only in the next financial year, which is FY24. So there will be some dip because of this shift in the existing product portfolio, but it will be more than compensated in the next financial year. So we expect some dip into the EBITDA numbers. May not be too much, but slight dip into the EBITDA numbers this year.
Got it. Because EBITDA margins, I think last year was closer to 12%. It has already come down to close to 7% is what you are seeing in FY22.
Yeah, this is again the same thing. There has been too many variations. Cost which has gone into development of the components which we are talking about D11 and D16. Then you are already aware, you mentioned about energy cost increase. And again, there also there has been some impact of the numerator denominator, which is optical because of the steel price and other price increases on the top line, which is only compensated to the extent of change in the price. So there is a mix of all these things which have impacted. We are hopeful, not very sure as of now how this energy cost is going to change, but probably it will continue to be there in the couple of next quarters, a higher increase in the energy prices. Subsequent to that, we expect that things might stabilize or may come down to normal levels.
Okay, as Siddharth, just to add to what Praveen said, FY23 will be a slight reduction both on revenue and EBITDA. We are working on, with various initiatives to ensure that in percentage terms we don't dip. But in the next year, FY24, the business will be back to normal, and we expect that we would be, double-digit EBITDA.
And just to add what Preetham said just now, these new orders, which is 11 liter and 16 liters, are coming at a better pricing because these are all new order wins.
Okay, understood, sir. Thanks a lot.
Thank you. Our next question is from the line of Jyoti Singh with Arihant Capital Markets Limited. Please go ahead.
Thank you for the opportunity. Sir, if you can throw some light on the other expenses, is the company doing any cost control?
The large portion of the other expenses constitutes the freight costs and the certain other variable expenses. And as you would know, the freight cost is the outward freight, especially on the overseas segment, has been a bit of a concern for the entire industry. So we are doing our bit to control that. But there is very limited that we can do in that sense as of now. So we were monitoring it very closely. We are finding out alternate ways, and in terms of negotiating with the customers and the contractors also. So.
Okay.
So we have a lot of cost initiatives that we are working on, not only in the area of packaging material optimization. A lot of renewable packing is being shifted to reduce our dependency on to reduce also impact on the environment, as well as to check the cost in control. We are also looking at consolidating from Bangalore plants the logistic expo. So a lot of work is being done both in that front, as well as not only on the other costs. We have also contracted almost 90% of, close to about 85 to 90% of this year's demand. We have contracted or we have set up facilities to come from the renewable energy. So we would have a significant cost advantage of that in coming into this year. So which will also have a offset effect on the inflation cost that we will have. So company is working on a lot of initiatives to see that we can offset the inflation cost that is going to come onto this year.
Okay, understood. And sir, what would be our future debt profile as in this year we saw the significantly growth on the debt?
We are estimating that our overall debt will remain constant in the current year based on our estimates, and whatever fresh debt we borrow will be kind of compensating the repayments that we have lined up for the year. So overall, we have programs in place to manage our cash in more controlled way. And despite the investments we are making in the working capital and in the capital assets, so we are planning to hold debt almost flat.
Okay, thank you, sir. That's it from me.
Thank you. Our next question is from the line of Deepesh Sancheti with Manya Finances. Please go ahead.
Yeah, am I audible?
Yes.
Yeah. So just I think most of my questions have been answered. Just one question is, when will you be able to give more, throw more light on the current order which we have received from US? Basically, what is the investment? What is the customer name? And what are the products we will be developing or making over there?
So I think it will take another at least a quarter. So I should be able to give you more clarity towards when we have the Q1 call. So we would have much more clarity on our time frame, investments, and everything.
Okay. And interestingly, you've not mentioned the customer name. So is it because of some agreement or?
Generally, most of the customers would prefer to keep their, unless that we have a specific, request and then approval from them. Generally, that is how it goes, is that they would not like to have that, because especially this is a newer technology as well. So, in this case, they have asked us to keep the name, confidential.
I understand. So, in this new technology, will we have to go through some R&D cost also, because since it will be a new product, or have we already done that?
This is the technological cost is on there, the thing. So we would not have anything specific to our component. This is a technology pertaining to the engine technology. So our components will be very much similar to what we do, except for there is a change in raw material front. Otherwise, not much of R&D cost on our front.
Okay. And the last question is whether the customer is also investing in the new facility. I mean, will he also be doing any co-investments?
In our
will it be a SPV or something?
No, it will not be. This would be purely our facility.
Purely Sansera will be investing in it, right?
Yes.
Yeah, and we will be also making products for other customers from this facility.
Absolutely, and it could begin earlier to this orders also. So we have plans for starting other components and other customers earlier to this, because this is a very significantly larger order. So we would like to have some kind of upfront production facility that is running before we do this. So that is the idea.
And what is the effect of the war on our European customers?
It varies from location to location and place to place. We have customers in Poland, facilities in Poland which was affected. Now it is restarting because there are a lot of people had moved over from Ukraine to Poland, and that city where this was located was choked. So later on it restarted. We have one customer, a North American customer to whom we supply is not a very significant order, but then close to about 25 crores per year. So there is an effect of for this quarter, which goes to actually Russia. So there is an effect on that. But otherwise, there is some disruption on energy availability in some of the steel mills where we have had supply disruptions, minor delay in another thing. But overall, there has been some impact on European customers, not a very significant.
Okay. And going ahead, are we even tapping into the EV market for India as well? I mean, are we supplying to the likes of Tata Motors and?
We are currently not supplying to Tata Motors, but including but not restricted to any of the customers. We are in discussion and progressing well on this front with a lot of customers. So there is a lot of work that is going on in this front. As you can see, we have also added customers in EV on two-wheeler front. As the numbers are going up, our business in this segment will also increase. So it will be similar for passenger vehicle as well. So we expect that technology agnostic and non-auto components, which stands at currently at 17% this year, would at least be about 22 to 22.5% next year. 50% growth. Yeah, 50% growth in this segment, and which is in line with what we have projected, that we would like to reach about 40% of this in the next 3 years to come. So we are very clearly in that roadmap.
Thank you very much. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to the management for closing comments.
So thank you very much, everyone, for your patience, hearing, and the support for Sansera. We are always available for any of the questions that you may have or clarifications, which could be answered either directly or through SGA. So please feel free to contact us, and we would be more than happy to interact with you. Thank you very much, and looking forward to having a conversation with you in the future as well. Thank you very much.
Thank you. On behalf of Sansera Engineering Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.